So whether you're Australian, whether you've been doing business in Australia or Singapore or Malaysia or France, Germany, Belgium, Spain, Brazil, Mexico, United States, Canada, India, I can go around the world. We've done training there locally, in person, as well as online. And interestingly enough, we'll therefore be covering a subject today, which is really about the global financial system. There are always local nuances, as you probably all are aware. For those of you who are in the United States, obviously we use the dollar. There's the Canadian dollar in Canada, and even obviously the rupee in India. And if you're from India, you'll also know that there are ancient ways of describing some of the dollar amounts, or the rupee amounts in crores and in lakhs. So some of this will be globalized, and hopefully you'll appreciate the nuances as we go forward. Again, we always look for feedback. We have Doug Carroll here. I'm muted. To kick this off, we're going to do a very brief presentation, about 2 minutes, of what this is all about and who we are. The program is being recorded for your benefit. Again, my name is Paul Siegel. This is the Global Financial Systems and Capital Markets Overview, which will be facilitated by Doug Carroll. We'll tell you about Doug in a minute. But first, I want to jump into a little bit of a understanding about who we are. Our business is called Starweaver. We've been in the banking and financial service training business, as well as IT and project management, for quite a while. We have lots of customers we work with pretty much on every continent, as I was saying in my preamble. From big technology companies to big financial services companies to, frankly, gas and electric and government agencies, etc. We pretty much cover these 5 domain areas. The one today is on banking and finance. We do live and recorded training. That means in person, it means online, but we also have a large library of courses, and you can check that out at starweaver.com. The programs online can be presented in the way that you see here, which is pre-recorded in mini modules of, in this case, about 9-10 minutes. We like to set that up so that you can actually keep access to this content on a permanent basis. We do also run an institute. While most of our customers are large institutions, we have a variety of programs there. One happens to be one that Doug is quite involved in, called Capital Market Immersion. We also have a Cyber Warrior certification we just completed, and there are many people who have participated in, as well as some upcoming Scrum and Agile programs. Check that out again at starweaverinstitute.org. This program is the 22nd of June at 1 p.m. Eastern Time. You will see that we have other programs coming up, 2 next week, for example, one in technology, one in finance, which again Doug will be facilitating on the 29th, one on technology, which is about TOGAF, which for those of you who have participated in these before, is run by a guy named Nasser Abou-Tal, quite good. These are the 2 programs in the finance area in July, and we will have more in July and August to be announced shortly. For some reason, I'm now told that the screen was not advancing. Okay, so I will not do that again for you. Okay, hopefully everyone can see my slideshow now. There was a quick bit of information. Since you have not seen it, I will quickly page through it, so at least you'll see what's there. Okay, lots of customers, lots of topics that we cover. Again, this is the kind of interface that I was pointing out you will see. If you log in, we do a variety of programs, as I mentioned in my verbal, but apparently the slides were not advancing. But the most important thing for you today is there are upcoming programs that you should be familiar with. Today is obviously, and there's one next week at the same time. And then there's one on Friday, which will be covering TOGAF, and et cetera. And then we'll be doing more. Doug will be doing more in July, plus there'll also be a variety of technology programs. You'll see probably 4 to 6 more added for July, and about 6 to 8 for August. Doug has been doing training in the finance sector for quite a while. He comes out of a very practitioner-driven approach. So one of the nice parts about working with Doug is that not only is what you're getting rigorously there's an intellectual element, a strong intellectual element to this, but there's also, he's been in the field, he's been in the trenches, so he can tell you exactly how this works from a real-time, real-world perspective. Again, for participating in this program, if you click on the link at the very end, Rand will provide that to you. That will give you access to one of our 17 courses online for free, just as part of providing you us feedback. Okay, there's the link. Rand will send it in the chat box on the right, and you'll be able to see that. Again, if you need questions, comments, or other things, please do send them to us. I'm going to pass the webinar off to Doug now, and let him take over from here. Thank you very much. I'm sorry for the slide delay there.
Well, welcome to Fundamentals Finance Session 1. And the session is Global Financial System, with an emphasis really on capital markets. The global financial system and capital markets are obviously crucial to the operation of the global economic system. I mean, maybe songwriters talk about love making the world go round, and physicists would talk about laws of celestial motion and gravitation. Obviously, in a commercial sense, it's money and credit, really. If money didn't exist, someone would have to invent it, or I guess the Lydians, about a half a millennia before the Common Era, get credit for the first precious metal coinage. Money's existed nearly always and everywhere, whether it was Sumerians using clay tablets, or prisoners of war using cigarettes, or commercial islanders using immovable boulders below the ocean surface. While trade can exist on a pure barter system, and maybe some Marxists would like to go back to that system, clearly a modern economy can't operate very efficiently without money and credit. So we'll focus briefly on money creation before talking about money and credit creation, before talking about the various segments of the capital market, and then subsequent sessions we'll dive into some of each of these topics in more detail. And as noted on the slide 2, the central players in money creation are the central banks and their close partners, the commercial banks. And before we get into the traits, and just to set some basics in place, oftentimes economists will define money as having 3 primary functions: medium of transactions, in other words, to make payments for buying and selling; unit of account, in other words, how do we track things; numeraire is a French word that tries to capture that idea. And in an ideal world, we have a very stable unit of account. I don't know that that's ever been the case in any time and any place. Perhaps in the age of the gold standard, there was a little bit more stable value associated with monies on the gold standard, but the reality is that the purchasing power of money, every money, always changes. And finally, store of value. In hunter-gatherer economies, they basically consume everything as it's obtained because there's not much of a way to store it. But with financial systems and evolved financial systems with many different forms of holding wealth, one can work today to save for a rainy day. Now, we'll talk about money creation in just a minute, but as we'll see, the money supply is actually a very small portion of the total value of financial assets. And indeed, without credit, in other words, borrowing funds or value from someone else to pay for something in the short run, there would be a tremendously lower level of both consumption by consumers as well as transactions by business. And so that really money and credit go hand in hand.
Doug, your voice is a bit muffled, so I don't know if that can be fixed, but just go ahead.
Well, I'll do what I can about that, Paul. So in terms of the creation of money, on the next slide, there's you can see 3 panels there. In fact, let's look at it gradually. So very stylized. There's the central bank. The Fed is the central bank and monetary authority in the United States. And as I indicated before, they work hand in glove with the commercial banks in terms of money creation. Now, these are very stylized balance sheets, and it should really say the left-hand side equals the right-hand side, or assets equal liabilities, and subsumed under the heading of liabilities would be the owner's equity in the entities. But just keep things simple. And for those without financial accounting, it might seem fairly mysterious, but the nature of double entry bookkeeping is that the assets and liabilities and owner's equities always have to be equal to one another. So we're going to assume, starting out, we've got a situation where the Fed has its balance sheet, and commercial banks, I have one representative bank up there, have their balance sheets in balance. Right-hand side equals left-hand side. And I'm simply noting that one of the assets in the bank's possession happens to be T-bonds. Well, how does the central bank create money? Well, one way that's done is through what economics folks would call open market operations. Its recent vintage has been QE, or quantitative easing, where the Fed, and this has been an activity mirrored by most of the central banks around the world, will buy securities, oftentimes treasury securities, but also mortgage-backed securities in the U.S. or corporate bonds in Europe. The central bank will buy assets from the banking system. So that's what the middle panel shows, or the middle set of diagrams shows, is the Fed has purchased the treasury bonds from the bank, and the way the Fed does that is simply by crediting the bank's deposit at the Fed. And that bank deposit is a liability of the Fed, but you can see it's become an asset for the bank. Now, there's still no money creation involved there, but the money creation is the next step. The next step is where the bank will decide to use those additional reserves, its deposit at the Fed, as a way of making loans to customers. Now, the loan becomes the bank's asset, and at least in the short run, before the borrower withdraws money from the bank, that loan takes the form of a deposit at the bank. And it's that deposit on the bank's balance sheet in the lower right-hand corner of slide 3, there's actual money creation. And as we'll see in the next couple of exhibits, there's been a boatload of money creation over the last few decades, and at an accelerating rate over the last few years. Now, before we look at the money creation, we can actually see the fruits, or the increasingly lesser fruits that have come about from that money creation. There you see the long-run growth rate of the United States, at least for the last 70 years or so. And without putting too fine of a point on it, you can see that over the recent decades, growth rates have been less volatile, although distinctly lower. One could easily see there's been a gradually declining trend line from the 1950s through the present. Clearly, the last couple of decades have been less volatile in terms of average growth rates, but on average, much more modest. I want to do some cherry picking and look at the growth rates from the end of the recessions in the early 1980s until just about the turn of the millennium. The average growth rates were at, or maybe even a little bit above, long-term historic averages over that time frame, but certainly more modest over the last 20 years or so. And as we'll see, that's despite significant growth in the monetary aggregates. Let's look briefly at some statistics on that. So here you see different measures of the money supply, and I'm not going to try to get too technical about it, but M1 is a very narrow measure, things that you could actually use to affect transactions, physical money, or checkable deposits, deposits you can write a check against. That's a narrow measure of the money supply, and M2, a little bit broader, it includes all of M1 as well as savings accounts and small size CDs and the like, money and near money. Now, in one sense, these graphs aren't ideal because you'll note it's not a logarithmic scale on the vertical axis. And so what looks like an increasing growth rate is not really, probably in terms of M2 anyway. There's been steady growth, but not increasing growth, at least in percentage terms. But note, this steady growth is in an era of declining economic growth. Steady growth in money supply has coincided with declining growth rates in the real economy. And a bit unfortunately, from the central bank's perspective, you'll note that since the Great Recession, M1, the narrow measure of the money supply, has actually grown at a fairly significant rate, despite the fact that that has not been mirrored by growth in M2. And at least in the long run, economic growth generally had a fairly stable relationship with the growth rate of M2. That's fallen apart a bit over the last few years. Now, part of the explanation is both the slowdown in velocity. That's the top exhibit on page 6. The velocity, without putting too fine a point of it on it, being the number of times a unit of money in the U.S., the dollar changes hands. And so this is one of the explanations for why, despite the increase in the money supply, economic growth has been flagging, is because money is not moving around anywhere near as rapidly. And that's also mirrored by what's known as the money multiplier. And again, without trying to get too technical, that's the relationship between physical money and M1, the physical money and checkable deposits. And you can see again, despite the Fed's effort to try to increase the money supply to stimulate economic activity, that's been offset by both the bank's creating of money, that's reflected in the money multiplier, and the activity of business, and that's reflected in the slowdown in the velocity of money. Unfortunately, the most economic policymakers are Keynesians, and they tend to view that low interest rates will stimulate economic growth. And that's a questionable contention, whether you look at the U.S. in the 1930s, Japan since the late 1980s, or most of the globe since the last Great Recession. Low interest rates in and of themselves will not stimulate growth unless businesses in particular have a reason to borrow money because they can invest it profitably. And in terms of credit, because up until there we were looking at the money supply, slide 7 actually shows credit growth. And in this case, despite the lack of a logarithmic scale, you can see by the increasing slope of the credit growth, upper graph being household and lower graph being non-financial businesses, the great increase in the amount of credit outstanding was not mirrored by rising growth rates, rather coincided with declining growth rates. So despite the vast expansion of credit outstanding, and we're looking at U.S. statistics, but this has been mirrored pretty much globally, most economies have been buying less and less growth with each additional amount, each additional dollar of debt, or yuan, or euro, or whatever currency you want to talk about. And of course, there was a contraction of credit outstanding as a result of the Great Recession, but the growth rates have picked up. Although in the case of U.S. consumers, they've reduced some sorts of debt, like mortgage debt, but have actually increased student loan debt and auto loan debt. And so the credit aggregates are picking up again despite lack of economic growth. Well, let's look at the capital markets and the system for moving wealth around and trying to employ it as efficiently as possible. So you can see on the next slide the primary economic functions performed by the capital markets. Probably the most quintessential application is trying to channel wealth into real investment. In other words, moving wealth from where it's accumulated to where it can be put to use. And I use the word real investment despite the fact that it says only investment on the slide. Excuse me. But understand that real investment means investment that's going to expand the productive capacity of the economy. Building factories, buying equipment, investing in new product development or worker training. So that's the investment that's being talked about there, and one of the primary functions of the capital markets is to try to move capital, wealth, into its most productive uses. Now, one of the ways it's presumably going to try to achieve that is by signaling where the highest return on capital is, and that's the second sub-bullet, pricing. So that ideally, where prices are rising, that's going to attract assets, attract capital to get the benefit of those high prices, which would normally mean high returns on real investment. And that's, again, one of the potentially unfortunate aspects of the central banks around the world keeping interest rates at close to zero for so many years, or even negative in some markets, because the interest rate is perhaps the most important price in the economy in terms of signaling where capital ought to be directed. And again, despite the good intentions of the central banks in terms of trying to increase economic growth, hiding the signals the market's giving off by manipulating interest rates might not be the most efficient way for allocating capital to its highest return uses. But beyond that, liquidity, in other words, the ability to convert assets into spendable form so that one can consume or acquire assets to build productive capacity, and also manage risk, whether it's through the acquisition of insurance by pooling risks among the insured, diversifying securities portfolios, or hedging with derivatives. All of those are functions of the capital markets. Let's look more closely at the capital markets and its primary segments. And there's a number of ways one could divide the capital markets up. This is one of many ways of possibly doing it, to say there's 4 segments: securities markets, derivative markets, currency markets, and insurance markets. And we'll look at them and their subsectors in more detail in just a moment, but before we do that, let's pause a second and think about exactly what a capital market is, or what capital markets are. And normally, markets are ways of bringing together buyers and sellers. And that's true whether it's a stock market, a bond market, or a flea market. But capital markets, the name might actually be misleading, because that would make it seem like what's being brought together are buyers and sellers of capital. And as it turns out, in many capital market transactions, there is no exchange of funds. Now, we'll see this in more detail in some of the later segments, specifically when we look at derivatives, but there's a number of capital market transactions that don't actually result in an exchange of capital. We'll see the details later, but with the creation of futures or forward contracts, there's no exchange of funds. There's an exchange of contractual commitments. The same is true in most swaps, at least if they're done at market, what's known as a par swap. Again, details to follow in subsequent sessions. But in many derivatives, the counterparties are exchanging contractual commitments to do something over time or at a later date, but there's no exchange of money for securities at the time of the derivative trade. And that's true in other derivatives too, but we won't talk yet about the deferred premium options and the like. But if capital doesn't always change hands in capital market transactions, what is actually changing hands, or what's being affected by all capital market trades? And perhaps a better way to think about capital markets than purely as a way of channeling wealth is the broader idea, and that is that capital markets are markets for pricing risk, because that's one of the things that always changes as a result of a capital market transaction. Money and securities aren't always exchanging hands, but what's always affected is the liability profile of the asset or liability portfolios of the parties to the transaction. And so oftentimes financial theorists will talk about the capital markets as markets for pricing risk or uncertainty, because regardless of whether one is exchanging a contractual commitment or exchanging securities, the ultimate outcome of that transaction, the impact will be on one's long-run assets or liabilities is not known. And markets try to assess prices today based on estimates about what's going to happen in the future, but clearly the future is beyond the ability of any of us to forecast very accurately. Well, let's look at the segments in a little bit more detail and talk briefly about their functions. So the 4 segments on the previous page are and I should note that before we go into them, that capital markets oftentimes are simply referred to as financial markets, almost another way of saying the same thing. So the 4 segments are the ones identified previously, or at least the 4 we'll start with: securities markets, derivative markets, currency markets, and insurance markets. Now, under derivatives, what I've got listed are really types of derivatives: options, futures, and forward, or swaps, excuse me. As we'll see later, this may not be the best way of categorizing derivative markets, because derivative markets are always connected to the markets for the related securities or commodities. Although the common definition of derivative, something that derives its value from something else, is actually at best misleading, if not downright incorrect. Because oftentimes derivative markets will move ahead of the markets they're presumably deriving their value from, which sort of stands the common definition on its head. That'll be one of the issues talked about in the 4th of the presentations in the series. But one way of thinking about the derivative markets is at least the different types of derivative contracts. Although, as we'll see later, swaps are either really packages of futures or forward contracts, at least the forward commitment swaps, and credit default swaps are really more like options than the other sorts of swaps. But the primary function of derivative markets is a way of sharing risk more optimally, as we'll see. What about the currency markets? Well, the currency markets, and by far the currency markets or foreign exchange markets, are the biggest markets in the world, biggest financial markets in the world. As an example, if you look at the biggest equity exchanges in the world, like the New York Stock Exchange, it's only 2 or 3 days worth of trading in the currency market that would equate to the volume of transactions for the entire year in the biggest stock markets in the world, like the New York Stock Exchange. The currency market is really a lot of sub-markets, markets between many different currency pairs, whether it's dollar, pound, or Swiss franc, euro, or dollar, yen, or Mexican peso versus the Malaysian ringgit. So it breaks down between any two currencies, of course. Although one important thing to realize is that the dollar is involved in something like 85% of all currency transactions. And part of that's a function of the centrality of the U.S. dollar to the global economy. Many commodities and other goods are priced in dollars no matter where they trade around the world. That's commonly true of gold, crude oil, even semiconductors in many cases. In fact, because of its liquidity in terms of other currencies, oftentimes when moving between two different currencies, one would trade through the dollar as an intermediate means of getting there. I'd mentioned the peso versus the ringgit before. Well, if an international investor or business had some wealth in pesos, Mexican pesos, and they wanted to move that into the Malaysian ringgit, they probably wouldn't trade Mexican pesos for ringgit directly. They'd probably trade their pesos for dollars and then dollars for ringgit, because the cross rates, that is the rate between the peso and the ringgit, because they don't trade against one another that frequently, would result in a very wide bid-ask spread, and therefore would likely be much cheaper to round trip through the dollar rather than trade two other less actively traded currencies directly against one another. The insurance markets are really markets for pooling risk, although one thing that's been true over recent decades is there's been an increasing securitization of insurance risks in the form of things like cat bonds, short for catastrophe bonds, where the bond sold by an insurance company will have a payout that depends on the success of the underwriting experience on certain sorts of things like, say, insuring against hurricanes in Florida. But the insurance markets break down by lines of insurance, whether it's life insurance or health insurance or property casualty. And of course, that's a form of savings in some sense, or pooling risks. And we'll actually talk about insurers as part of the discussion of the many different types of financial institutions in next week's session. The securities markets are probably the markets people think of most immediately when thinking about the capital markets, however. And one way of dividing up the securities markets is between the equity markets, the markets for ownership of well, usually corporations, but equity markets include many other things like exchange-traded funds, which allow you to invest in commodities or other things. And then there's the bond markets, or debt securities markets. And while the man on the street probably thinks of the equity markets more immediately, as equity investments are more accessible for most individual investors, the bond markets on average are significantly larger, so that in most developed economies, the bond markets will be anywhere from 2 to 4 times the size of the equity markets. And that's true for a variety of reasons, although that's an issue we'll explore in more detail in the third session in this series. Where's credit markets, though? Now, oftentimes, speakers on the financial networks will sort of use the phrases bond markets and credit markets and fixed income markets interchangeably, terminology we'll talk about in another session. But realize the credit markets are much bigger than the bond markets. So that the size of the credit markets for credit instruments, obligations that require some borrower or obligor to make payment in the future or payment over time, they're significantly larger than just the bond markets. And so yes, many credit instruments get securitized, as we'll see in another session, in the form of mortgage-backed securities or asset-backed securities. Many debt obligations, credit instruments, remain bilateral contracts between a borrower or obligor and the holder of that particular claim. I'm not going to spend a lot of time with this exhibit. This one is more there for those who want to take a look at some reasons for trading and how they're connected to various functions of the capital markets. But issues that I'll talk about in more detail in later sessions. But let's look at some subsets of the securities markets and focus more closely on their primary function, the channeling of wealth into real investment. Most economics books never get down to this level of detail. Most introductory economics books, even at graduate schools, can hardly admit there's a set of financial markets. They barely can handle money. But those that bother to do or try to capture a financial system will talk about wealth building up in the household sector and that wealth being channeled through the securities markets into real investment in the business sector. And again, recall the implication of real investment, building factories, buying equipment, developing new products, etc. So the household sector presumably is willing to invest their money as a form of savings to increase wealth for retirement and future consumption. And in return for investing money in the businesses, at least for publicly traded businesses, there'll be an issuance of securities that represent the claim those household investors have on the issuing business, whether it's an ownership interest, an equity security, or a creditorship interest. A bond, in effect, is really nothing more than a loan that the investor has made to the issuing business. Now, as far as it goes, this captures at least some aspect of reality, but it certainly misses much of the granular detail one would like to have of trying to understand capital markets or securities markets as they actually function. Because there are a couple of important things that are missing. Well, the vast majority of equities and probably 90+% of the debt securities are not owned directly by individuals or households in the household sector. The bulk of the securities holdings and the vast majority of trading is done by the institutions. And there's a short list of the types of institutional investors that, in effect, are intermediating between the investors in the household sector and the securities markets. Now, it's not that the basic model that I introduced that shows up in the few economic texts that try to address it is wrong. It just misses this level of detail, because most of those institutions are clearly investing on behalf of investors that reside in the household sector, whether it's pension funds investing on behalf of current or future retirees, or insurance companies that are taking the premiums received from the insurance buyers and investing that to be able to make payments on future claims, or investment companies, mutual funds, investing on behalf of the small investors who have invested in the mutual fund and get the benefit of broader diversification and lower transaction costs by relying upon the mutual fund. And there's others, and we'll talk about all of these institutions as part of the discussion next week when we talk about the financial institutions and other financial firms. But clearly the bulk of the day-to-day buying and selling and risk management over time is not done by individuals in the household sector. They typically don't have the time or the expertise to do so. They're relying upon professionals to manage those investment decisions and risks on their behalf. And while businesses are a significant issuer of securities, they're clearly not the largest, at least not in most developed economies, because typically governments are the largest issuers, primarily the national governments and their agencies, although depending upon the structure, where there's a federal structure such as the provinces in Canada or the Scots in Germany or the states in the United States, the local, regional and local governments may also be significant issuers of securities. Now, phrases that are often heard, buy side and sell side, we can associate those right here. Because the buy side, of course, is the investing side of things, the pensions and asset managers and the like that are doing the buying, whereas the sell side are the issuers and the banks and brokerage firms that represent them, the underwriters. Let's take another look at subsectors of this market. Because this channeling of wealth into real investment done by the financial firms and the others acting on behalf of both parties, we'll spend on the next page, but let's go to slide 14. Let's think about the capacity in which the different financial institutions act and the market segments under which they conduct their activities. So the two primary ways the institutions can act is either on their own behalf, that is acting as principal, or on behalf of others, that is acting as agent. And the significance of those differences we'll focus on in more detail in later sessions. But again, principal means the firm's trading for its own account. Acting as an agent means executing a trade on behalf of a client. And normally, at least in a trading sense, the firm is only putting capital at risk in principal transactions. When they're investing on behalf of a client, whether it's a broker executing a trade or an asset manager investing funds that have been invested with them, in general, it's the client that's bearing the risk of those transactions or investments. And at the bottom, it just segments between a couple of different types of firm trading activity on its own behalf. So in some cases, the firms are simply trying to make money by providing liquidity. That's what a market maker or dealer does, and we'll see some examples of that on subsequent pages here. Although many trading firms will also commit their capital to investment in the hope of generating better returns over time. That's what's known as proprietary trading. And while both are a form of principal trading, there's a distinct difference between the two. Market making, again, they're trying to make money by providing liquidity, capturing a bid-ask spread, as we'll see in just a moment. Whereas proprietary trading is putting firm capital at risk. And there's a wide variety of ways that might be done. And again, this is an issue we'll look at next week a little bit more closely. But clearly, these are activities that have been heavily influenced by regulation in recent years, Dodd-Frank in particular, putting great restrictions on proprietary trading by certain types of financial institutions. Now, the securities markets that we looked at briefly several slides previously are oftentimes segmented between the primary markets and the secondary markets. Now, the diagram several slides back was really the primary market being the sale of securities by or on behalf of an issuer. And those can be public offerings made to investors at large, whether institutional or individual, although a significant number of transactions are privately placed. That is not through a public offering, but through private negotiations between an issuer and one or a smaller number of investors. Most people are probably more familiar with the secondary markets, however. That's NASDAQ or New York Stock Exchange are examples of secondary markets. And those might either be exchanges, used to mean a trading floor, now it's really mostly electronic, or over-the-counter. And there's a distinct difference between the way those two markets operate. The first one is primarily an order-driven market, where the exchange will match up orders between buyers and sellers, whereas the over-the-counter market is more what would be described as a quote-driven market, or a dealer or market maker market, which is diagrammed on subsequent pages. But which of these two markets accounts for a greater portion of the transactions? While the quintessential function, channeling wealth into real investment, is really the function of the primary market, the vast preponderance of transactions take place in the secondary market on the order of 90-10 or maybe 95-5 or even 95-7. An issue we'll come back to later. It's important to realize that the vast majority of transactions are not really channeling wealth into new investment. They're really more in the nature of liquidity and risk management sorts of trades than actually making funds available for new investment. Some people mistakenly think that means that the securities markets are really just well, it's a sham, a paper chase. Oftentimes one of the critiques of Marxist critics of market or capitalist systems. The reality is, however, without a thriving secondary market that would allow investors to dispose of investments or manage risk, you wouldn't have a very viable primary market. So let's look more closely in the last few minutes at those two market segments and their functions. So in the primary market, the vast majority of sales are not directly by issuers, but through underwriters acting on behalf of issuers. So underwriters, well, there's usually not a single underwriter, but a managing underwriter who creates an underwriting syndicate, a group of banks or brokerage firms who have joined together. The negotiations are conducted by the manager, but they're acting on behalf of the entire syndicate. And generally, they'll agree with an issuer. Could be a corporation or a government agency, although most governments sell securities directly, not through an underwriting syndicate. However, agency debt as well as corporate debt and state and local debt is typically sold in this fashion. The managing underwriter on behalf of the syndicate will agree with the issuer to provide a set amount of funds. You'll note the heading there says firm commitment underwriting. In other words, the underwriters are making a firm commitment to buy all the securities from the issuer, regardless of how well or how poorly the subsequent sales to investors go. So upon reaching agreement, now the funds are not provided up front. These funds will be delivered after the close of the offering, but the amount that's being, the amount the issuer is going to get is typically guaranteed by the manager and the syndicate members. And this would be true for probably 98, 99+% of the securities underwritings, although they can also be done on an agency, what's known as a best efforts basis. That accounts for a very small percent of the overall transactions. So after reaching agreement, the underwriters buy the securities, the stocks or bonds from the issuing corporation, government agency, whatever it happens to be, and then they attempt to turn around and sell those securities to investors. And of course, in the ideal world, they're going to get more from investors than they've promised the issuer. Now, if this is a successful offering, like when Apple's second largest its second debt sale, which at the time was one of the largest, in fact, by a corporate issue up to that time, about 3 years back, they sold or attempted to sell about $17 billion worth of bonds in a single offering. Well, investors placed orders for close to $50 billion. So clearly in a situation like that, the underwriters made all the money they had anticipated. And in fact, the problem was making their clients happy because all of the orders couldn't be filled. On the other hand, the first time there was a $1 billion debt offering, now this is somewhat dated, it goes back to 1979, but at the time, $1 billion was a lot of money. So in the first $1 billion bond offering by IBM, it was priced too aggressively. The underwriters were only able to sell about half the offering to investors, but the underwriters promised IBM basically $1 billion, and so the underwriters ended up having to buy half the bonds themselves. That's the significance or the implication of firm commitment underwritings. Now, some offerings are made directly between issuer and investors. All private placements are done that way. There might be a bank or broker involved as an advisor to the issuer, but they're not buying for resale to investors. On the other hand, most major country governments, whether it's German, Japanese, UK, US, they sell so many issues of security so frequently, all they need to do is announce the fact that they're going to conduct a sale, and investors are placing orders typically for a big multiple of the securities they have to sell. The bid-to-cover ratio, as it's known, on most U.S. Treasury offerings is usually 2, 2.5, or 3 times the number of orders to buy as there are bills, bonds, or notes to sell. Now, this is the primary market, and this is sort of the quintessential function, the directing wealth into real investment, or new investment anyway, although in truth, many issues are simply paying off pre-existing issues that are maturing. The bulk of transactions take place in the secondary market. So in the secondary market, you've got trades between investors. Now, in some cases, it will be between investors directly. That's true on most exchanges, which have electronic order systems that match up orders between buyers and sellers. Although there are also electronic networks that institutions subscribe to, where they can list securities blocks they wish to sell or acquire and negotiate direct transactions with one another. But most of the bond market transactions do not take place in that fashion. Bond trades occur in any given issue, at least, less frequently. And so ready buyers and sellers for the same issue of bonds do not as often materialize at the same time. So the bond market is typically a dealer market, whereas an investor that might want to sell bonds will find a dealer that is willing to buy them. Now, the dealer's not buying for investment purposes. As I said before, dealers are typically in the business to make money by providing liquidity. So after they buy bonds from one investor, they're hoping to turn around and sell those to another investor, ideally almost at the same time, although hopefully not too far into the distant future. And where the dealers are making money, of course, is the difference between the price at which they're willing to buy, the bid price, and the price at which they're willing to sell, the ask price, also known as the offer price. So the bid-ask spread, the spread between the price at which the dealers are willing to buy or sell, that would represent the dealer's profit on an individual trade done on both sides of their quote. Now, of course, the bid is the dealer's the bid is the price the dealer is willing to buy at, and the ask is the price the dealer is willing to sell at, bid price being below the ask, or ask price being above the bid. That's how the dealer's making money. Naturally, if you're trading with a dealer, you're on the other side of the trade. So the buyer, the investor that wants to buy, in this example, investor B, they've got to pay the price that the dealer is willing to sell at, and the selling investor, investor A, they've got to sell at the price the dealer is willing to buy at. So the clients are always on the wrong side of the bid-ask spread, if you will. Now, the important functions of the secondary market, and it's important to be clear on what the purpose is. The secondary markets are not directly channeling wealth into real investment. As you'll note, in neither of the diagram trades here is the issuer getting any of the funds. But despite the fact the secondary markets don't channel wealth into real investment, they perform two very important functions. One is what we've talked about already, the liquidity. And that might be simply to convert securities into cash that can be spent on consumption or real investment purposes, or it might be a matter of moving money out of one investment into another. But in addition to that liquidity, the other things that the secondary markets do is they provide information about the current value of investments. Primary markets price things once only at issuance. And given the reality of existence, things change constantly. So for markets to act as efficient allocators of capital, they need to give off signals about current returns. And that's what the price discovery is a reference to. Secondary markets are continually repricing the value of assets based on expectations about risk and return. And to the extent markets can function efficiently and not be too interfered with by governments, those price signals will presumably signal where there are higher returns available, thus attracting capital into investment in those sectors in the economy, and where capital ought to be reallocated away from, where returns are relatively low. So I hope all the listeners have found the presentation helpful, and look forward to speaking to you in subsequent sessions.
I hope you enjoyed this video. You can go to our YouTube channel or Facebook page to see other videos on a range of investment-related topics. Or you can go to the website, insidersguidetofinance.com. At our website, in addition to the free video shorts, there are a series of modestly priced, in-depth training videos with running times of approximately 1 hour each that go into a number of subjects in greater detail. The website and Facebook page also contain information about open enrollment programs I will be presenting over the next few months, and my recently released book, The Insider's Guide to Fixed Income Securities and Markets.